This presentation will be for demonstration of exercises for Chapter 1, Accounting and the Business Environment. If you want to try the problems yourself and then check your answers, I am going to review S1, E118, E120, E126, and E119. Stop or pause the video and work these problems and then return, and you can watch the video to see the answers. In this exercise, we will identify for each user of accounting information if the user would use financial or managerial accounting information. The first user is an investor. An investor is an external user and would be interested in financial information. This would also be true for a bank and the Internal Revenue Service. These are external users who would use financial information. The manager of the business and the controller are both internal users and would use managerial information. The stockholder, again, is an investor in a corporation and would use financial information. The human resources director is internal and would use managerial information. And last, the creditor is external and would use financial information. In this slide, we are going to match the terms 1 through 10 with the definitions A through J. Try these yourself and then see if you have the correct answers as I go through each one. A sole proprietorship would be D. Owner is referred to as a proprietor. Faithful representation would match to E. Asserts that accounting information should be complete, neutral, and free from error. A partnership has 2 or more owners called partners. IFRS or IFRS is a set of global accounting guidelines. Corporation is a type of entity that is designed to limit personal liability exposure of owners to the entity's debt. Audit is an examination of a company's financial statements and records. Cost principle holds that fair market value should be used over actual cost. FASB stands for Financial Accounting Standards Board. Creditors are the person or business lending money, and the SEC is a U.S. governmental agency that oversees the U.S. financial markets. This exercise is meant to determine if you understand the accounting equation. Remember that the accounting equation is assets are equal to liabilities plus equity. Then you can solve for the missing amounts. If you know that the liabilities are $36,000 and equity is $36,000, then the assets are equal to the sum of these two, or is $72,000. If you know that the assets are $90,000 and the equity is $48,000, then you can determine the liabilities by subtracting the equity from the assets. $90,000 minus $48,000, and that gives $42,000 for the liabilities. If you know that the assets are $101,000 and the liabilities are $68,000, then you can solve for the equity by subtracting the liabilities of $68,000 from the assets of $101,000, and you get $33,000 for the equity. This exercise is to give you practice analyzing business transactions. Remember that the accounting equation has to be equal, so we either make an increase to assets and either liabilities and equity, or we decrease both of them, or we can have an increase and decrease on one side, such as increasing one asset and decreasing another. Also in this problem, we are going to start using account titles to identify the specific asset, liability, or equity component that would be increased or decreased. The first transaction would increase assets cash and increase equity common stock $10,000. The next entry would increase assets, accounts receivable, and increase equity, rental revenue by $2,800. Notice the words on account. When you see these words, you know that the business did not receive cash, but instead allowed the customer to have the services on credit. If the business is earning money, then the on account is going to be accounts receivable. Next, for C, we would increase assets, office furniture, and increase liabilities, accounts payable, by $300. Notice again the words on account, but this time we are being allowed credit, so the correct account would be accounts payable. Next, we would increase assets cash and decrease assets accounts receivable for $400. Notice the words on account. Since we are receiving cash, the correct account would be accounts receivable. Notice that this transaction occurs all on the left side of the accounting equation, but the equation is still in balance because increased and decreased assets by the same amount. In the next entry, we would decrease assets cash and decrease liabilities accounts payable by $100. Notice the words on account again, but this time the account is accounts payable because we are paying an amount we owe. Next, we would increase assets cash and increase equity rental revenue for $200. Then we would decrease cash and decrease equity office rent expense for $1,000. Both of these last two entries involved equity because the business is generating income, rental revenue, and expenses, office rent expense, as they operate the business, and this affects the retained earnings of the business, which is part of equity. Last, we would decrease assets cash and increase assets office supplies by $100. This entry again is all on the left-hand side of the equation as one asset is decreased and another increased by the same amount. This exercise tests your knowledge of accounting vocabulary. We will match the accounting term on the right with the definition on the left. The accounting equation is the basic tool of accounting, stated as assets equal liabilities plus equity. Asset is an accounting resource that is expected to be of benefit in the future. The balance sheet reports on an entity's assets, liabilities, and stockholders' equity as of a specific date. Expense are decreases in equity that occur in the course of selling goods or services. Income statement reports on an entity's revenues, expenses, and net income or loss for the period. Liability are the debts that are owed to creditors. Net income is the excess of total revenues over total expenses. Net loss is the excess of total expenses over total revenues. Revenue is increases in equity that occur in the course of selling goods or services. Statement of cash flows are reports of a business's cash receipts and cash payments during a period. Statement of retained earnings reports on how the company's retained earnings balance changed from the beginning to the end of the period. And that is the conclusion of the presentation for the exercises for Chapter 1.